Stuck in a system that just ain't right. Gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly. I burn down the walls and break the chains, shatter the illusions, expose their games. The stock market's a stage. I'll steal the show with my rebellious spirit. Watch me grow.
And here we go. Welcome. I am Matt. This is the Anarchist Investor live, coming at you every Monday through Friday at 12 Eastern. Happy Friday, TGIF. Talking about contrarian investments, markets, the economy, how to protect and grow your money without it getting stolen by some dirty banksters. So I'm going to pull down the banner. And today is kind of the culmination of a week of just like, not even really like market moving stuff, right? Like market economy. There wasn't really like a whole lot of clarity that came out of this week. And so it was just kind of a bunch of back and forth. There was a lot of, what traders would call churn. Some people taking profits in some areas, other people putting positions on in other areas. And it wasn't really, like a huge mammoth kind of shift, at least from the standpoint of like data and from like individual data points. However, I would like to point out the fact that it's Friday and we've had 4 days now of basically red candles in the casino. So like if I put this up, this is the S&P index. We've had 4 candles on the daily chart that posted red days. Now, the first red candle, I believe, was still an up day. I could be wrong, but it was like a gap and pullback. But regardless, I mean, it's basically a downward trend in terms of the S&P. The question being, why? Or like, why is that, right? I think the thesis I've been operating on all along is the market is going to pitch a fit eventually. All right. It pitched a little bit of a fit like earlier, or late April, headed into May. That was supposedly, the narrative was supposedly based off of, this anticipation that it's entirely possible that the Fed might raise rates, right? Which I think is absolutely ridiculous. I think if rates go up, they'll actually go up without even the Fed acting for those rates to go up. But I actually don't think that's a high likelihood scenario here. I think the most likely scenario is you're going to see the market pitch another fit, right? There was this relief rally here, which I already made the point for earlier in the week. Looks like a topping pattern. And so typically what happens in a topping pattern is you get this final rally, which is basically hopium, that, okay, everything's all clear, or the magical Jerome Powell, money helicopter is going to come in sometime, right? And then it doesn't materialize, and then it doesn't materialize, and then it doesn't materialize. And the longer that we go without the Federal Reserve announcing that they're going to ride to the rescue here with their Ben Bernanke helicopter, the closer that we get to the point where their hand is going to be forced. And typically Wall Street is the tail that wags the dog. Wall Street will end up pitching a fit. You will see weakness in the markets. You'll see some considerable weakness in the markets, and it will probably coincide with something else blowing up. Okay. The most likely scenario is another bank. That I would say, if you're like placing odds on this or handicapping what ends up kicking off this next stage of the cycle. I mean, from my perspective, I think it's probably another bank collapse. But it doesn't necessarily have to be that way. It could be, like I said in the past, it could be a dramatic rise in the oil prices and energy prices. It could be unemployment just cracks and cracks hard. Okay. And I've already talked about how the unemployment numbers are masking the actual reality of the employment situation out there in the broader market. But even that mask will come off, and the employment picture will, it actually has cracks in it right now, right? It's being covered up, right? Like they're throwing some spit and some polish on it to make it look better than it really is. But truthfully, that lagging indicator will eventually confirm what most people already know, that the employment picture has not been good for a while. Okay. Even though they're, the corporate investment media, as well as, the powers that be in the White House and the Federal Reserve, are trying to tell you all along: strong labor market, strong labor market, strong labor market, or resilience, or whatever other buzzword they want to throw in there. But really, you have a number of things, not to mention the fact that the White House the news story just came out that the White House secretly told Israel that they can, or not Israel, Ukraine, that they can use bombs to attack inside of Russia. So now you're talking about the White House giving the go ahead to their proxy army to then stage an attack inside Russian boundaries. Does that result in World War III? I mean, that's also another, possibility here. I think that's actually probably less likely than the other scenarios. I think more than likely you're going to see something financially break, or it's already been broken, and just we're going to end up hearing about it. Okay. Now, interestingly enough, Fridays, usually bad news gets announced over the weekend. And so, like, when banks can't reopen their doors, usually they can't reopen their doors like Saturday morning, or technically that's, Monday's business date, because there's no real Saturday business date because it's Monday through Friday. Banks that try and fund themselves overnight can't Friday night, and then they go, "Oh, sorry, can't open our doors." And that's usually what happens over the weekend. So could it happen this weekend? Who freaking knows? But I want to call your attention to the news, at least as far as the PCE number that we got earlier today. This is actually the Fed's preferred inflation gauge, if you want to call it. But it's just a, 6 of one, half dozen of another, right? Like, whatever you want to look at in terms of CPI versus PCE. So this is the story out of Yahoo Finance. Feds, and this is also funny. After I read this, you'll see the irony here. There's like two stories and they both contradict each other. Fed's favored inflation gauge slows in April while price increases remain sticky. Okay. So essentially what they're saying is that the number came in as expected. The massaging was done very well. The numbers came in as were forecasted. Essentially, core inflation, which is core PCE inflation, which is what the Fed likes to look at, is basically year over year at 2.8%. Okay, which is slightly hot according to the fact that the Fed wants 2%. All right. Now, that being said, I want you to notice this 0.8%. Okay, is so close within spitting distance that if something does happen, you can see very quickly that, an over 2% inflation number can become an under 2% inflation number. Not to mention the fact that if all of a sudden it becomes politically advantageous, or advantageous from a PR standpoint, that the numbers get massaged to show dramatically lower inflation, don't underestimate their intention to do those things. Okay, there is a propensity for these numbers to overstate things when things are good, and to basically understate them when they're bad. But there has to be this flip, and typically the flip they can't smooth out. Okay, so when things flip from good to bad, it's not like they can be like, "Oh, okay, we'll just, land the plane," right? Like, everyone's using this soft landing, no landing, hard landing bullshit imagery, right? They can't massage the numbers to land the plane softly. So when you get this switch over, happened in 2008, when you get this switch over from the good to the bad, or what they perceive as, the better to the worse, it typically doesn't happen, just slowly over a number of months and months and months and months. I mean, you could make the argument that the slow kind of landing has attempted to happen over the last like 6 to 12 months, because in certain areas of the economy, you have seen dramatically lower pricing. And so there's other areas of the economy, namely like 2 or 3, that are driving most of this inflation narrative. Okay. Everywhere else where there was supply chain disruption, you're seeing a lot of those supply chains heal. And that basically means that the pricing becomes more rational. Okay. Doesn't necessarily mean that the prices go down. I talked about it yesterday. Prices are, if you want to call it, highly elastic going up. Like they can go up and respond to, supply constriction or demand increases very quickly. Okay. They're inelastic when it comes to prices coming down. And so they come down very slowly, barring some kind of economic calamity. Okay. Which it's actually my prediction that that's what the Fed is essentially hoping for, to give them the cover to then come through and start to cut rates. Okay. And I think it's going to happen sooner rather than later, because the longer that this kind of sits the way that it is, the bigger that explosion is going to be when it finally happens. Okay. So they're just looking for an excuse to cut. This 2.8% number is extremely close to what their, target is. Not to mention the fact that Simon over at Uneducated Economist has covered this time and time and time again. The target isn't such that the Federal Reserve, or at least now, the current definition, isn't such that the Federal Reserve is looking to peg 2% inflation. They are telling you it's a target, but it's technically a target range, because they know they can spend some time under 2%, they can spend some time over 2%, and in their minds, it averages out to 2%. Okay? So you also have to keep that in mind. Everyone wants to think that, like, oh, they're not going to cut until inflation is at 2% or lower. That's not true at all. Because like I said, when things go from, good to bad or from better to worse, okay, it's like a freaking light switch. All of a sudden, the numbers look bad, and they make them look bad, or they allow them to look bad, because it gives them the political cover to intervene in the marketplace, right? It's worth their while to do that. Now, I mentioned before, look at this absolute ridiculousness. Hold on. Let me see if the homepage is still the same. Yes, it looks like the same, because the cookies haven't updated yet. So here, if I share this homepage with you, this is Yahoo Finance's homepage, okay? Just look, the stories are right next to each other. New inflation reading won't shake Fed's posture, meaning the inflation number came down, or at least it's moderated in their mind, but that means that the Fed's going to hold rates higher for longer, okay? So the Fed's going to be resolute. You can have trust in the Fed. And then right below it is Fed's favored inflation gauge slows. Okay? So does that mean that, why do we need 2 stories that basically, do they say the same thing? No, I don't think so, because one's highlighting the slowing of it despite the fact that there's quote unquote sticky prices. And then the other one's telling you that they're now resolute because it's still high and we have to worry about high inflation and it reigniting and things like that. It's just these kind of things are nonsensical, right? This is the illusion of trying to remain neutral. And so net on net, they basically end up saying nothing, right? Like it's not even useful. I try and translate it so that it turns into something useful. But if you're just a layperson and you read those two headlines or the 2 articles, you get nowhere. I mean, it doesn't really give you any kind of functional understanding of the marketplace and where we're headed. So anyway, after that diatribe, let's look back at the market. I'm going to be pretty quick today because it is Friday. It is options expiration. So you always have to remember that, the market makers are literally actively pushing the market up and down in order to shake options contracts out so that they don't end up losing money in their positions. The market makers, that being said. And so, I tend to not confer a lot of market movement here onto things. But that being said, the title of this episode has to do with me kind of weighing my options and in that value averaging world that I like to live, in terms of, am I going to allocate most of my monthly stuff towards one thing, other, equally split it up? Okay. And so from my standpoint, this month and for the next probably couple of months, I'm probably going to be allocating more money towards value averaging into crypto than I will into precious metals. Okay. I've spent time building up a portion of my portfolio in gold and silver. I'm not liquidating any of that really right now. I do have some prices at which I might take some profit just to kind of increase, replenish my cash stores so that then I can take advantage of some things when they go on sale in the future. But I'm going to make the case here for why I am emphasizing purchasing crypto more so than gold and silver right now. All right, so let me get the share screen up here. We're going to, and again, really quickly, I'll look at the casino just because I kind of started with it at the top of the show. Casino's down today. There's a ton of profit taking. Again, this could be the beginning of the fit, right? This could be the beginning of the crying baby wanting their whatever, their snack, their treat, their cookie, and they're not getting it. All right. So remember, and this could get pretty bad. You could see a 10-15% sell off in the market, which will then induce the Fed to act, which will get you basically a dead cat bounce in terms of the rally that follows the rate cutting. And then that dead cat bounce will roll over, and you will then see the worst losses of this, the downside portion of the cycle, which will also coincide with unemployment increases and all kinds of bad stuff. Companies going out of business, probably more banks blowing up, et cetera, et cetera, et cetera. So market's down today. Again, it's options X, but could this be the beginning of the fit? I think it could be. This is a very good candidate for that. So we'll have to see what happens with future numbers. I actually think corporate profits have topped out. We'll see. We still have yet to get an updated reading on corporate profits. So I'll have that when it becomes available. What else is going on in the casino? Dollar's relatively flat. There's a little bit of volatility increase in the volatility index. Crude oil continues to be weak here for the last couple of days. But again, this doesn't necessarily mean a downtrend. This could simply be basing, and then we have to figure out which way we're going, up or down after that. If this is kind of like a descending triangle, typically that resolves to the upside, okay, which usually means a rally afterward. So we'll see how that works out. Copper's weak again today. Lumber's weak again. So a lot of commodities are weak today. Gold and silver. Silver's taking it on the chin for another day. For some reason, trading view is being really slow today. But silver's taking it on the chin for another day here. Silver's back down at like $30.50, give or take. And if I zoom in here, you'll see some of the trading activity that's happening. This wedge, silver's broken through the bottom end of the wedge. We don't have confirmation until it comes back up and retests the wedge and fails. Okay, so just remember that. The other thing that could be happening here is this wedge really easily can just turn into another one of these consolidation patterns. So we'll have to see how silver reacts, especially if it comes back down here and tries to test $30 per ounce. Okay, how it reacts down here, if it even gets down here, is going to be something to watch. I mean, you could totally see a scenario where over the weekend we get news and silver finds its way right back up in the top of this wedge, if not through the wedge. Okay. Does that mean that I should be buying more silver? No, I don't know what the resolution is here. I think over time, silver is going to be moving higher, but I think the first big move higher is actually going to be crypto before gold and silver. And a lot of that is going to have to do with economic news and whether or not we get any of these kind of like big like blow up kind of events. It's actually my thesis that we're not going to get a blow up event for a little while. Okay. So I talked about at the top of the program, like, this weekend something could happen. I'm not anticipating something happening this weekend. I'm actually, thinking that that's still kind of like down the road. Right. Which basically means that gold and silver are that, catastrophe hedge. They're the insurance. They're also a hedge for inflation, meaning once it's anticipated that the Federal Reserve is going to intervene in the markets, they should resume their move higher as well. In fact, they'll do it ahead of the Fed actually doing that. Well, we've gotten a move. So maybe that was already the move. Maybe that's the move before the move. Who knows, right? But from my standpoint, I'm actually thinking that crypto is going to be stronger here going forward. Also of note, look at this, man. I called attention to it 2 days ago, and it's like gold-silver ratio, right? Came down, hit this trend line right here at the bottom, this level of support, bang, popped right back up again. And part of that was yesterday, gold being up and silver being down. And part of that is also, again, today, gold's down, but only a little bit, whereas silver is seeing a lot more selling pressure. Silver is going to be a lot more erratic than gold. It just is. I mean, that's just the way, it's just the nature of silver trading. Okay. It's also the nature of how manipulated that marketplace is. But that's a topic for another video another day. What are we seeing here out of everything else? That's really what I'm looking at in terms of like commodities and the indexes. If I look at high yield bonds are catching a little bit of a bid today. Interestingly enough, that's contra what you would think is happening based off of the stock market being down. High yield bonds are catching a little bit of a bid, but why are they catching a little bit of a bid? Because in the short term, people are buying U.S. Treasuries, which means rates are actually dropping a little bit as a result of it. We have under a 4.9 on the 2-year yield. Okay, this is a notable move. All right, and yeah, it's happening on a Friday, so it's kind of contra my thesis that Fridays are manipulated. But the 2-year yield move below 4.9%. This is a significant moment here because you've seen a lot of this price action headed higher. Okay, the 2-year more days. Let me put it this way: the more days that the 2-year spends below 4.9 and specifically 5%, but below 4.9, the more likely it is that this thing is going to roll over and drop and will probably get the Fed saying they're cutting rates at the same time. Okay. The more time that this number stays below these highs, not to mention the fact that now you've got a lower high in this chart. Okay. This lower high, we'll have to see how it reacts when it pulls back here. Does it go to put in another high, anticipating that the Federal Reserve is just going to keep rates where they're at for the next 2 years? Highly unlikely. And so I don't think it's a smart bet, so to speak, if people are anticipating that the Federal Reserve is going to keep rates at 5.25 for the next 2 years, which is essentially what the 2-year yield is telling you. Okay. What it's telling you today is that, the more likely scenario is that over the next 2 years, rates will be like 4.9% or less. All right. I would actually think that it's more likely over the next 2 years that rates look lower than they are now. Now, rates aren't going to be zero, but I don't think that rates are going to be up at 5.25 or 5.33 where they are right now for the next 2 years. And so you're going to probably see more buying happening. The yield curve de-inversion has taken a little bit of a pause, even though there's a bunch of buying in the U.S. Treasury market today. So we'll see how that resolves Monday and Tuesday and see whether or not that resumes or if we go back to this, 0.4 difference inversion between the 2-year and the 10-year. Remains to be seen. But yeah, high yield bonds are up because the U.S. Treasuries are down in terms of yield, meaning there's buying in U.S. Treasuries. So some lending gets cheaper, okay? Which means zombie companies are stayed and can exist for another couple of days. Again, when this de-inversion starts to take place, you'll probably see high yield corporate bonds. They'll fall off as the market pitches a fit. They'll then get some support because there will be a rush to safety, meaning U.S. Treasuries will rally. Rates will come down, and so there will be this this will be part of the dead cat bounce. It'll be like, oh, lending rates are going down. And then all of a sudden, everyone's going to be like, oh, crap, it's too late. They're already out of business. Okay. And that's when you'll really start to see this fall off happen. That's exactly what happened in 2008, exactly the way it happened in 2000. So I'm just kind of going with what history tells you. All right, crypto. This is why I'm saying that I'm probably buying more crypto, and specifically Ethereum. Okay, specifically Ethereum. And a lot of people will say, oh, well, you've been poo-pooing the ETF and all this other stuff. Look, at the end of the day, the goal is make money, right? We do have some, philosophical reasons why I stay away from certain investments. I am not staying away from Ethereum just because Wall Street is mucking around in it. What I am doing is staying realistic about what's going to happen, okay? I do think that Ethereum will see a continuation of this rally. Let me call it that. All right. So this rally off of the anticipation of the Ethereum ETF approval. All right. You've now seen, this rally. You've now seen a little bit of a consolidation period here. You could call this a bull flag formation. All right. I would expect Ethereum to move higher. If this move gets fully realized, all right, I'm going to throw a measurement on here. You could expect probably a 30% move from here. And so that 30% is going to put you somewhere around like 5,300, give or take. Let me redo that just in case. So yeah, 30% from the top of this move is going to put you at, yeah, like 5,200. Okay, 5,200. So you could see plus 5,000. If it's fully realized in terms of the broader pattern for Ethereum, all right, that ends up looking more like a 75% move. Okay, you see this kind of like, there's like this, it's not a flat neckline, but it's like a diagonal neckline. And this has a similar formation to what Bitcoin does on the longer term. Left shoulder, and this is an inverted head and shoulders for anyone just listening. There's a left shoulder, there's a big head, and then there's this very truncated, tight right shoulder that's happening here. I think it's more likely that you get the 5K and less likely that you get the full realization here in terms of the move. But if we do get this full kind of like 75% move, or actually I'll call it like 70 conservatively, this 70% move, and let me just make sure I'm getting my frame of reference better here. This 70% move from the neckline is probably going to look something like, you're going to be looking at like in between 6,700 and 7,000 on Ethereum. Okay. I think that's less likely. I think the more likely move is plus 5,000 on Ethereum. We could end up fully realizing that, 7,000 number in Ethereum. I don't see it happening. I would not expect this to be fully realized. I think it's going to be a quick spike. There's going to be a short opportunity to take profit. And then after that, the economics of the actual economy will take over. Meaning people will have to sell assets like gold, like silver, like crypto in order to raise cash, to pay off debts, to actually pay their mortgage and their monthly bills and things like that, or simply just because they're afraid. Okay. That's also another reason why I'm going to look for opportunities to take profit, because I think there's going to be things that are on sale that I'm going to want to buy into. And it actually won't be crypto. It'll probably be more likely, it'll be real estate. It'll be gold and silver at first. I'm going to get super, super, super conservative when the stuff hits the fan, right? That'll be the first things that I'm looking to get into. The things that hit the hardest typically are the ones that bounce back first and the quickest, but they're also the highest risk. And so if they bounce, like this is a big point, if they bounce, they're typically the first ones to bounce back, and they bounce back the hardest. But if they don't, well, they might not bounce back at all. And in some cases, they'll go to zero. So that's something to also remember. So when things go on sale, I'm going to be super conservative and calculating in what I'm purchasing. But there's a profit-taking cycle that has to happen first. And so I would anticipate 5,000 in Ethereum, which is why I'm being more bullish on Ethereum and Bitcoin specifically than I am on, say, gold and silver. Okay. And I have the luxury of having built a gold and silver position. So I'm just sitting here playing out the string with gold and silver. I'll probably still buy a little bit here and there because I can't help myself. Right. But, I'm not going to be actively, pushing money, pumping money into gold and silver. I'm going to let that price action play out for me. I think this price action is going to be quick. Now you might say, oh, well, why is it that you're doing this like that? Isn't that trading? Right? Like, isn't that trading that you usually don't advocate for? Yeah, it's a little bit. It's taking an outsized bet, right? It doesn't mean that I'm ever going to trade 100% out of Bitcoin and Ethereum just because of this one move, all right? But I do anticipate that over the next couple of months, probably like 3 to 6 months, you'll probably see Bitcoin and Ethereum outperform, specifically Ethereum outperform gold and silver. And I actually think Ethereum is going to outperform Bitcoin over the next 3 to 6 months just because of the news. Like, people can't help themselves psychologically. They chase shiny objects. Okay. The shiny object is the Ethereum ETF. So, yeah, I think you're given a decent opportunity. The other selling point here is, again, it's Friday. Okay. Crypto plays by slightly different rules because there isn't really like a full derivatives marketplace. You can place bets on futures, so it does change things a little bit, but there's not really like a robust market maker, ecosystem that's pushing crypto one way or the other on a Friday, right? On a random Friday. And so today, the broader marketplace is down. So the crypto market cap is down 1.2%. Okay, so overall crypto is down 1.2% today. Bitcoin is leading it lower, meaning Bitcoin's worse, being down 2%. And Ethereum is actually showing some green. Okay, it's actually showing a positive take. At worst, right now, maybe you could say it's unchanged. But that's strength. On a day where the entire crypto marketplace is down, Ethereum's up or flat, that's strength. And so I think that's a show of strength for the next probably couple weeks, and maybe even 3 to 6 month time frame. So, and again, a lot depends on how quick. If we get to 5,000 in Ethereum really quickly, I will turn into a trader. But from the standpoint of I'm locking in profits, right? Like that's the corollary here. All right. But yeah, the Ethereum piece of my portfolio will be growing faster than the Bitcoin piece, as well as the gold and silver piece, and the other things like real estate and whatnot that I'm putting money towards. So something to keep in mind. Again, that's only what I'm doing. I'm not a financial professional. I'm not like a certified analyst or anything like that. You make your own decisions. If you decide to follow that, that's fine. That's on you. You have your own, investment perspective. All right. Yeah. So that's a lot of it. I mean, most of the crypto space is down today. And so Ethereum's bucking that trend. There's a couple of small differences like Monero, Helium's up just a little bit. And that's really it. I mean, Cardano, but I mean, like, I don't know if I would be putting very much money into Cardano. I'm not a big Cardano person, but there was some noise about Odyssey, I think, looking to partner with Cardano to build on that platform, but I'm not sure I've seen anything solid as far as that goes. So, and does that move the needle? I don't know. We'll have to see. Again, Cardano's strong on a weekday in the market, so could be something. You could always take a lottery ticket, I guess, and buy a little Cardano. Or if you're a big Cardano person, then I guess you're rooting for that to move the needle. We'll have to see whether or not that plays out. A reminder, if you didn't catch it, go and either check out the rest of my my Twitter feed for the interview that dropped last night with Vinny Barbarossa, Barbosa from Finbold, and check out that interview, or head on over to the YouTube or the Rumble channel and check it out. Fantastic interview, wide ranging. We talk about a number of things like Bitcoin, like Nano. He's a big Nano user and Nano advocate. Talk about Hive a little bit. Talk about the state of the crypto space, as well as just being a crypto writer, a crypto reporter for Finbold, which was some good information too. So definitely check that out. And help me out with the algo if you made it this far. Hopefully you got some good information out of it. So give me a subscribe, follow, a like, a share. It goes a long, long way towards helping me and towards helping the channel. And on Monday, I will be giving away 4 free annual paid subscriptions to the Anarchist Investor Substack. So if you're not currently subscribed, at least for free, to the Substack, head over to anarchistinvestor.substack.com and just put your email in, and you get the articles for free in your email, and you're involved in a free giveaway for 4 annual memberships. That annual membership's worth $99. So keep that in mind. It's a pretty decent score there if you hit. That's really what I got. I mean, it's Friday. I'm going to go have a fantastic weekend. My daughters are both performing in their rock bands this weekend, so I get to go hang out and listen to some old school music that my, young daughters are playing and freaking singing and rocking out and playing guitar too. So it's going to be a good time. Hopefully you have something fantastic lined up for this weekend as well. Yeah. And always, I want to say thank you. I appreciate each and every one of you taking time out to, take part in this content, listen to it. Hopefully you get something from it. And, I'm on this trip for you as much as I am on it for me. So I'm glad that you're here with me. But with that, yeah, it's going to be a fantastic weekend, hopefully for everyone. And I will be back here Monday at noon Eastern live, talking about the markets again. So definitely subscribe to get notified, and subscribe over at the Anarchist Investor to be in on that drawing on Monday. So with that, have a fantastic weekend. Love you. Peace.
Stuck in a system that just ain't right. Gonna tear it down. Gonna start a fight. Anarchy with my rebellion.